Kathryn Rooney Vera. She is chief market strategist at StoneX. And Kathryn, we're looking at numbers, trying to figure out ahead of the jobs report where you think markets are valued at this point. There's a lot going on in the globe, and yet markets are powering higher.
They absolutely are, and they've wholly discounted the perfect scenario, not the soft landing, but the absolute perfect outcome. I think that inflation expectations are too low and don't correspond with the upside risks to inflation, especially from rising geopolitical risks, supply and demand issues that will probably push oil prices higher. And if I'm right and we do get a surge, a potential surge in oil prices, we could see CPI move 1 full percentage point higher year on year, which would complicate the scenario that the markets have currently priced in, which is wholesale upside for the economy and markets going forward.
That's before you even factor in the stoppage at the docks. I mean, we've heard
Correct.
0.3% for every week that they're closed.
Absolutely. And I would tell you one more thing, that if, in fact, we do get a surge in inflation, I look at this in a bipolar risk adjustment scenario. You have the risk of recession, which is not nothing, and then you have the risk of reacceleration in inflation because of the potential for an overheating of the economy. Because remember, potential growth in the United States is 1.8%. The nowcast is pointing to third quarter growth at about 3%, and we're already growing at 2.8%. So there's inherent risk from that perspective. Add to it both monetary and fiscal easing, as well as upside potentials commodity prices, because China is engaging in this bazooka of stimuli if they effectively execute it. Then I think we're pricing in, or the markets are expecting, too many Fed cuts and too rosy of a scenario going into next year.
Those OPEC guys lie, I think. $50. I think that's massaging their members to not cheat. Is there oil's?
Well, it's also warning that Saudi Arabia is going to pump,
right,
and not lose market share at this point. If you guys cheat, look out.
It would be good. I mean, we produce a lot of oil here. I'd like to totally cut them off at the knees, all their power at some point. Wouldn't it be nice to live in a world where we weren't always talking about OPEC and what they're deciding to do to
they have been much less relevant.
Much less relevant. Good.
Kathryn, let's talk a little bit, though, about people who are taking the opposing view on that. Goldman yesterday, someone put out a note there suggesting that his year-end target of 6,000, he was worried was too low, because seasonally, he said, you get through the election and there's usually a relief rally as you kind of figure out what the knowns are instead of worry about what those unknowns are.
And he's not wrong. Momentum is certainly to the upside in the near term, so I wouldn't discount that we get to 5,800, 6,000 by the end of this year, but that doesn't mean that we don't see risks in the offing. And I think, Becky, that when you see complacency of this level, I mean, today we have the VIX breaking 19, going to the upside, but when you do see the VIX drop, that makes option protection and protective hedges cheap. And you want to be deploying those when the markets are pretty exuberant. And I would say protect your gains. Our top pick coming into this year was utilities, and utilities at a certain point in the past month outperformed year-to-date tech. It's up 30%. So at this point, what we're recommending is take gains on utilities and rotate into another defensive that has outperformed this year and could do well next year, which is healthcare. Gold has done remarkably well. It's probably looking a bit overbought at this point, but I do like protecting your gains going into next year, especially when we get this level of complacency in the markets.
Healthcare, is that contingent on either party winning in the election just because of some of the, or is it more specific where you're not necessarily looking at big drug companies?
Oh, it's just a play on evaluations and what has yet to play catch up. But I think going into the election, we've never seen the markets react so positively a month before the election. And in my team, we looked at the past 24 elections going back about 100 years. And in the 3 months running up to the election, historically, this is a very accurate predictor. The S&P 500, if it's up the 3 months before election day, the incumbent party wins with an 84% probability. So that's one variable of many, but it does play into the wealth effect. And if people are feeling good, they vote for the incumbent party. There's been a few exceptions, Nixon, Eisenhower, and Reagan, where that didn't play out. And I do think this case could be different with inflation and immigration being the top issues, but the wealth effect is still there. And
if money on the sidelines where people are feeling
right. And if the S&P continues to power higher, I think it gives the advantage to a Harris administration.
What else do you like beyond healthcare? You said gold's powered higher.
Yeah. The other things that I like within the sector are if we continue to move higher in the AI trade, industrial real estate, because as we all know, the utilities and industrial real estate are a second derivative to AI. So I do think that if we see a continued move higher there, you want to play the second derivative trade. And if, in fact, we do get a contested election and the markets drop, then I would be a buyer of the S&P.
What about the number that we're waiting for tomorrow, the jobs report? How important is that? How important is the Fed's reaction?
It's absolutely critical now. Labor market has taken the place of inflation with regard to the importance to the markets. And I think the volatility inherent in markets right now is because the Fed is so data dependent, which in my view it shouldn't be. And I think that's actually a detracting factor to the markets. Being so data dependent, the markets are going to be hanging on every labor market piece of data that comes out. We have initial jobless claims today.
Yeah.
I think September's data tomorrow comes out strong. My bet is about 200,000. That's above consensus. But the big question is what happens in October. And I think there's going to be an ugly labor market report because of the furloughs and the strikes and the hurricanes for the month of October.
I mean, to some extent, we can look at every data point and be worried about it. But overall, the Fed has decided that it is going to ease, and maybe that's more important than any of the rest of it. Is that why you're saying don't be so data dependent, just look at the broader overall move?
Look at the broader overall move and the fact that there is a dual mandate with inflation not hitting that 2% target on average, and the potential of a reacceleration therein. So I think they're wholly focused, obviously, on the second part of that mandate, which is the employment sector. Maybe they're right. I mean, the jobs gap between guys who think jobs are plentiful and those that are hard to get is widening, and we do see a deceleration there. But I think it surprised me that the Fed cut 50 basis points. I'm not sure that we're quite ready for moves like that. I don't expect another one.